Well, the Atlanta Fed has come out with quite the startling estimate today. Their GDP Now model is forecasting a mere 0.1% rate of growth in the U.S. economy in Q1. Coincidentally, the end of Q1, also known as quarter one for those of you not in the know, that ends at the end of March, which is when the Fed is supposed to come in and announce their first rate hike. Now, 0.1%, it's technically positive, but it's basically zero. And so if the U.S. is decelerating in growth down to zero growth on an annualized basis in Q1, do you think the Fed is going to be hiking rates in that environment, hiking rates into a recession? Because that's the next step. Obviously, when you go from positive growth to negative growth, you have to cross, zero before you go negative. Well, Atlanta Fed is saying we're going to hit zero by March, and so Q2 is going to be negative. Middle of the year, we're going to be in a recession. Well, I guess technically it's a recession if it happens for 2 quarters. So by the November elections, we're going to be in a recession. And yet the big banks want us to believe that the Fed is going to hike, 4 times this year, 5 times even. Now, because the Fed has come this far in saying that they're going to hike rates in March, I think by this point Powell has passed his personal point of no return. In that, once he says something enough times, and once he's made himself, sufficiently clear, I think he feels obligated to, because it's already priced into the market. Powell has never really surprised the market with any moves. He forecasts it way in advance, like a year at a time. And we also have the dot plot, which if Powell didn't want that kind of, if he didn't want the dot plot around, which is a instrument for telling the public, hey, here's what, different members of the Fed think. Here's what sort of the Fed board in general is thinking. And for those of you who don't know, the dot plot is it's a chart of interest rates, and each member of the Fed Board of Governors gets to plot where they think interest rates will be in the future. And so it's the Fed's way of telling us, what they intend on doing down the road, even if they're not talking about it yet. And Powell has been hyping up the idea of a March rate hike. Now, then again, if we really do go into a recession by then, or at least if we're in negative growth territory by then, which, again, 0.1%, basically negative, maybe Powell will want to surprise the market by not hiking rates, because that's all he can do. Obviously, he can't cut rates unless you want to go negative, which, again, I think that Powell looks at how that's gone in Europe and correctly thinks that's not something that we should pursue here. So the options are at this point, the Fed will hike as expected, or they will try and surprise the market to the dovish side by not hiking when we are going into a recession. And I still would not rule that out, even though, I moderated my position a little bit because the Fed has been so adamant that they're going to raise rates in March. I moderated my position from saying, okay, there will be 0 rates, to saying there will be net 0 rates. Meaning, okay, sure, maybe Powell will hike once just because they've been saying that they will, just to do it, and then he'll immediately cut at the next meeting, and we'll be back to 0, and we're going to stay that way, for the foreseeable future. But again, if the Atlanta Fed is already forecasting 0% growth in Q1, and we're still in January, we've got a lot more of Q1 left to go, where the situation can deteriorate further. We have plenty of time to enter a bear market in stocks, which, as we all know, that's the Fed's real favorite metric. Now, obviously, well, I shouldn't say obviously, maybe some of you haven't listened to this channel long enough to know my position. So I will revisit it, what I think about monetary policy. I think that the entire idea of monetary policy is fraudulent and offensive. I don't think that we should have, central planners issuing us money Or trying to dictate interest rates and set interest rates, which, frankly, they're not even that effective at. Interest rates don't exactly always go where the Fed wants. But in short, I think that the Fed's machinations in our economy, as well as the fractional reserve banking system in general, has led to a gross distortion in asset prices in the American economy and the global economy at large, which has been very negative for society at large. Asset prices are well above where they would be in a market economy, and interest rates are well below where they would be in a market economy. I would very much like to see the monetary authorities essentially target a fixed level of the money supply if they're going to do anything, in order to promote a society in which savers are rewarded, where you're incentivized to save money, where the value of your money is always going up instead of going down, where the cost of living continually goes down, in which case the price of risk assets would necessarily collapse, because saving your money in a bank and lending it out would be quite rewarding for people, and so they wouldn't have the need to chase yield by buying stocks or junk bonds or real estate as much. And so therefore we would have less of the ridiculous excesses on Wall Street, which get the most headlines. We would have far more affordable housing, and we would have a great social incentive for people to save their money, which is something that anybody can do. You don't have to have some fancy financial advisor who thinks they're a lot smarter than they actually are. All you would need in that case, is a savings account and discipline, the discipline to put that money there and let it grow over time. And even if you were to just leave that money, stuff it under your mattress or put it in a safe, your savings would grow over time, because cost of living would fall year after year, year over year, rather than rise. This is what we saw in the late 19th century during the Industrial Revolution. So that's just a short summary of where I think the economy needs to go, and the way that we would get there would be by popping the current bubble. But people like me are not in power. I will never be in power. I can assure you that. So I try and predict, or I shouldn't say predict, that's the wrong word. I try and analyze what's going on, and, well, I guess predict is the right word. Predict what's going to happen next, what the people in power will try and do, how effective they'll be, and what the situation is going to look like moving forward. And so I'd say there's probably a 60% chance at this point that the Fed hikes rates. That can go down if the situation continues to deteriorate. Powell might start signaling that, maybe we won't cut rates, because he didn't outright say it, but he basically said it at this week, that they're going to raise rates in March. But that can be reversed. The Fed they go with the flow. My view of the Fed was heavily influenced by a time I met a member of the Fed Board of Governors. I won't say who, but he was someone. He was one of the higher ups at an important Fed bank, and he was on the Board of Governors. And I asked him about these sorts of things during the last tightening cycle, when Trump was president, in the wake of the tax cuts, when Powell was new in office as the Fed chairman. I was asking this fellow, what are you guys going to do? Because you're raising interest rates, it's going to have consequences. You're going to pop, you're going to pop the asset bubble, which even back then was huge. Now it's who knows how much bigger, maybe twice the size. I'd have to look at a chart of market cap to GDP. And so I said, obviously, you guys don't want to pop that bubble. So what are you going to do if that happens? And he says, we don't worry about it, think that far ahead. We raise a quarter percentage here, quarter percentage there. If we raise a little too much and it starts to break things, then we can just cut at the next meeting. It's no big deal. And so essentially the Fed's just feeling around in the dark, looking for the light switch. And if they mistakenly stick their hand, in the toaster might burn for a second, but their attitude is, oh, we'll just pull our hand right back out. But what separates now from situations that the Fed has been in the past is that they normally have quite a bit of time in which they're raising rates to get themselves comfortably away from the zero lower bound. If we remember back in 2008, by the time that crisis rolled around, the Fed had raised interest rates back to like 5%. And they only ever got back down as low as 2%. Now, after 2008, they had 5 percentage points, 500 basis points from which they could cut. That's a big cut. Going from 5% to 0%, which is where they're at now, that's a big cut. By 2020, from 2015, I guess it was, like they raised rates once and then they didn't all 2016 and then they started raising them again after Trump got elected. I think they got up to 2.25%, which is less than half of where rates were in 2008. And they had to stop then. It's not like, oh, well, they'd gotten up, they'd raised rates up to 2.25%, and then the Wu flu crisis happened. And they said, oh, well, pandemic, we have to cut rates. No, they'd stopped cutting rates at the end of 2018, start of 2019. It had been, over a year for the Fed, or at least a year. They were already done raising rates. They left them there. 2.25% was the most that our bubble economy, the greatest economy in American history, if you ask Donald Trump, that economy could only handle a 2.25% Fed funds rate. It's pathetic. It's anemic. It's a joke. And so when the Wu flu crisis rolled around, the Fed was only, they immediately cut 2.25% down to 0. And now look where we are again. We're at 0%, and we're going into a recession, according to the Atlanta Fed. So what are they going to do? They're going to cut. The Fed's supposed to be tapering QE. Well, what are they going to do? Just restart QE, go back up, end the taper. That's all they have left. Fed's a one-trick pony. Oh, and we have the whole inflation problem. The Fed's supposed to be fighting inflation. Do you think the Fed's going to be fighting inflation into a recession? What happens if we have a recession and inflation? What happens if we have stagflation? It's the Fed's worst nightmare. How could we have possibly ever seen this coming? Nothing like this has ever happened before. At least not at any time in these fools' careers. Because pretty much everyone in finance these days, except for, old crustaceans like Carl Icahn and, Warren Buffett, nobody remembers what it was like before 1980. If you've been in this game since the 80s, you've never lost. Not really. You know that as long as you hang on, sure, there might be dips here and there, but within a couple of years, you regain all that, and in the interim years, after you break even, you make, so much money year over year for all those years. It makes up for if you lose money for a couple of years. We've had a 40-year bull market in bonds. Financial assets are king. Yet, as soon as there's a little bit of inflation, if the Fed decides to act and try and crush that inflation, which they're not doing, a 0.25% rate hike, and they're worried about inflation, yeah, right. You'll never, at a 0.25% hikes, they'll never get high enough to crush inflation. But if they did, all those silly little assets that people have purchased, their 4.5% high yield bonds, they're going to be worthless. If the Fed raised rates enough to actually fight inflation, you'd easily get, 4.5% off of a 10-year treasury. But the Fed's never going to get that far. And so, once again, I will say, inflation has to be transitory. The Fed didn't just say it over and over again, because he wanted, because it was fun. It's the Fed and all of us are screwed, at least in the short term. Obviously, I think it would be best. I would think it would be best for us in the long term. If anything, even inflation puts an end to the Fed's little game and the game that the federal government's been playing for decades. I want this to be over. I want to be on the road to recovery. I used to be a lot more sure of myself. I used to be a lot more sure of what was going to happen with the economy. I've learned to be humble. And I can't let my personal, desires cloud my judgment. I can't tell you that I know something that I don't know. I don't know how we'll get there, but I know how this ends. I don't know how long it'll take us. I don't want to play that game. But where this goes is a very, very rough place. There's no way out of this inflation. It either goes away on its own, or this is the end of the current system. Although I guess what might be our saving grace is the old saying, the U.S. is the cleanest dirty shirt in the hamper. And we just enter a period of severely negative real interest rates, which we're already in a period of negative real interest rates. You look all the way out the Treasury yield curve. What's inflation supposed to be at now? 5 to 7%? You see any bond anywhere on the yield curve yielding 5 to 7%? No. Every bond or bill on the yield curve yields significantly less than 5 to 7%, which means Treasury yields are negative. The entire yield curve is negative in real terms. And so, that has to continue forever. And maybe it will. Maybe it's just that. The U.S. is the cleanest dirty shirt. They have been since World War II. That's why the U.S. financial system became the most important in the world. Everyone was destroyed after World War II. Japan, Germany, Russia, England, France. And the U.S., the U.S. took a beating in World War II. But it was in the best shape. Had the most gold. Had the cleanest balance sheet. Least amount of debt. Relatively speaking. Obviously, there was a lot of war debts, but back then, the U.S. owed a lot of debt to its own citizens. And ever since World War II, the U.S.'s dominance has not just been, in military terms. The U.S. has been the center of the financial universe forever. The best assets to own have been American assets. And that's kept us afloat. So much to the point to where, people are willing to accept negative interest rates to own federal government debt. It costs you money to loan your dollars to the U.S. federal government. But the fact of the matter is people are willing to do it. And as long as that is going on, the U.S. can't go bankrupt. This whole system will continue, and it'll perpetuate itself. Because treasuries, I don't want to get it too deep into the weeds, but treasuries they're the core of the financial system. Treasuries are really base money. And so with all that said, as long as the financial system remains intact, remember, 2008 was a crisis, according to Lee, because it was a financial crisis, not because it was a depression. Now they said, oh, well, if you don't bail out the banks, then it'll be a depression. It's not a depression as long as the banks get bailed out. Since the banks got bailed out, that's not considered a depression. Even though by plenty of other metrics, the U.S. has been in a depression for a long time, and that, by a lot of metrics, the last decade has been worse than the 1930s. A recent episode of Jeff Snyder and Emil Kalinowski's podcast went into that a bit, and I think they made a very compelling case. And so there's no reason to believe that things can't get worse, and that as long as the financial system remains afloat, the economic elite will do nothing to abate that pain. And so those of us on the ground could be in for a very rough period ahead. And and our livelihoods will be sacrificed if it means preserving the current financial order. If the choice is between crushing inflation and crushing the financial system, the Fed's going to pick the financial system to preserve. So, with that said, I will see you folks back here tomorrow.